Hi everyone, welcome back to your Investing Masterclass. This is an exciting week. We will be covering exchange traded funds, or as you might know them by ETFs. I have two of my coworkers here with me today, Grace MacEwan and Hyslop. And between the three of us, we are going to cover what exactly are ETFs, what are some of the benefits, some of the drawbacks, and who should be buying them. So let's get right into it.
Hi guys, I'm Grace and I'm going to be explaining ETFs in general and comparing them to mutual funds a little bit and then leading into who manages ETFs. So an ETF is a pooled investment security that holds multiple securities instead of just one. So this essentially means that you can buy a large bundle of different stocks, commodities, bonds, and other investment types all in one singular purchase. So think of an ETF as an investment basket. So for example, let's think about the jar of candy that Steven hands out in personal finance class. The Jolly Ranchers are the stocks and the chocolate bars are the bonds. And then the jar of candy itself, that's going to be your ETF. So except in this case, only one investor gets the entire jar instead of each class getting to pick out their own preferred piece of candy. And later on in this video, Andre will circle back to the candy example to explain some of the benefits of a diversified investment. So ETFs can hold multiple stocks across various sectors or can be isolated to one particular sector or industry. So ETFs are considered a highly diversified investment, and it's always important when investing to ensure you have a diverse portfolio to minimize risk. So now we're going to be moving more into ETFs versus mutual funds. So ETFs are highly comparable to mutual funds, which are another investment that bundles many different securities. But there is some key differences between the two. So similar to individual stocks, the share price of ETFs can fluctuate throughout the course of a trading day. But mutual funds only trade once per day after the market closes. They're not traded on an exchange. This is why ETFs are referred to as exchange-traded funds, because they exchange on the stock markets just like stocks. So now we're going to be moving a little bit down to who manages ETFs, which also kind of ties into ETFs versus mutual funds. So another one of the major differences between ETFs and mutual funds is their management style. Mutual funds are actively managed, which means they're typically managed by humans that trade stocks in and out of the mutual fund based on their prediction of how each stock is set to perform in the future. So ETFs, on the other hand, are passively managed, which generally means they're not managed by humans. So most ETFs are managed by artificial intelligence, and they are programmed with an algorithm that tracks an index or an economic sector and bases exchanges on the information gathered. So these different management styles make management fees for ETFs significantly less than those of mutual funds. And this is just because automated investing programs are typically cheaper than paying fees that professional mutual fund managers would charge. High fees add up. So with an ETF, you can maintain a low cost on your investment and in turn get higher returns. The general opinion on ETFs and mutual funds is that an ETF is considered a more cost-effective investment than mutual funds, and it's also a more liquid investment. All right, guys, that's all from me. So now we're going to be handing it off to Andre, who's going to discuss some benefits and drawbacks of ETFs.
Hey everyone, in this segment we're falling into the fascinating world of exchange-traded funds, or ETFs. More importantly, we'll be exploring the advantages and disadvantages of ETFs, highlight some examples of high versus low performing ETFs, and address some common misconceptions about them. So a few of the benefits of investing in ETFs include that it provides instant diversification, as they typically include a wide range of assets such as stocks, bonds, and other financial commodities. They typically help spread the risk more effectively than investing in individual securities. The second one is ETFs have a tax advantage compared to mutual funds due to structural differences. Mutual funds typically incur more capital gains tax than ETFs, and ETFs only incur capital gains tax through the sale by the investor. One example I like to use when describing ETFs is through candy. When you buy one chocolate bar, you're essentially buying one security, but what if you take one bite of that candy bar and it turns out you don't like it? Well, through ETFs, you can buy a smaller portion of an assortment of securities. That way, if you aren't a fan of one of them, you can always eat around it. A few of the potential drawbacks of ETFs include that if the ETF is thinly traded, there could be a liquidity issue. This depends on the size of an investor's position relative to the average trading volume. The biggest indicator of a liquidity issue is the spread between the ask and the bid price. Another issue could be limited control, because investors don't really get to select the assets in their portfolio. Instead, they get an expert to do that for them. And another one would be they're designed to track and not beat. ETFs are designed to track indexes, sectors, or other assets, which means funds often won't outperform their underlying assets in the index. Individuals seeking more risky investment or potentially more profitable investments might be willing to look at other products. And lastly, they are taxed differently on dividends compared to mutual funds. They're less advantageous for ETFs. If the fund is held for over 60 days, they're considered qualified, which means that they can be taxed from anywhere from 0 to 20% depending on the investor's income tax rate. So in recent years, a great example of a high-performing ETF is the Invesco QQQ Trust. Not only has it demonstrated an impressive 17.59% average annual returns in 2010, but the company as a whole has shown substantial growth. On the contrary, energy-focused ETFs have faced challenges due to volatility in the energy sector. This tells investors that they should look at sectors as a whole before making an important investment decision. So now we'll be talking about a few common misconceptions about ETFs. Firstly, a lot of people think that they all follow the S&P 500, but in reality, this is far from the truth. They can track a wide range of indexes or specific sectors, but in reality, they're designed to follow various asset classes based off investment strategies. Another misconception is that they're often confused with ETNs, which are exchange-traded notes. However, investors should remember that they come with different risks, such as solvency issues. Now I'll be sending the rest of this discussion off to Lily Walker. We hope you found this information helpful, and happy investing.
All right, thank you, Andre and Grace. So now that we have a better understanding of what ETFs really are, what they're made of, some of their benefits, you might be asking yourself, who are these for? Who's supposed to be buying exchange-traded funds? And the answer to that is that ETFs are for everyone and anyone interested in investing. It's really just up to personal preference and how much risk you're willing to take on. Because like anything on the stock market, there is more risk involved than buying something like a government bond. But there are three big things to remember about ETFs. So first of all, they follow large sectors on the market. Second, they easily diversify your portfolio. And third, they are fairly risk adverse compared to buying individual stocks. So does that mean that the risk lovers, the day traders, or other shorter term investors shouldn't invest in ETFs? No. But if your goal is to watch the stock market all day and wait for that perfect day or perfect second to sell your stock, then ETFs are probably going to be pretty boring for you, because although ETFs do fluctuate with the market day to day, you're not going to get crazy returns from them each day, which is why they're best to keep long term. But just because you are someone who prefers to take on more risk with the majority of your stocks, it definitely does not mean that having a few long-term stocks like ETFs in a separate portfolio is a bad idea, kind of like a security blanket. So we call most risk-adverse long-term investors passive investors. These are people who generally use a buy and hold strategy when it comes to investing. And I'm going to show you why this is a generally safe way to build your income using ETFs to follow that broad market-weighted indexes like the S&P 500 or the Dow Jones Industrial Average. So the general graph of an ETF or a lot of stocks that follows something like the S&P 500 is usually going to look something like this. Now, if you're an active investor who checks their portfolio every day or every week, it can be a little exhausting to watch the market fluctuate and affect the value of your portfolio, because one day you may look at it when you're at this point and you'll feel on top of the world because you're making money without really doing anything. But then you check it a week later and your stock's down here and you begin to stress and panic that you're going to lose everything. That is exhausting. But the thing to note is that historically, stocks rise over the long periods of time. So if you have the money to put away now and not touch for many years, then ETFs are a good way to go. Oh, right, that is everything from us. Thank you to Grace and Andre for your demonstrations. And catch us next week on Your Investing Masterclass, where we will be covering RSPs. Happy investing!